Hello, Southwest Florida homeowners and homebuyers. Welcome to the 239 Real Estate Roundtable podcast, your go-to source for navigating the vibrant real estate landscape of our beautiful region. I'm your host, Kevin Tremmel, a local real estate agent, leader, and investor here in Southwest Florida. On this podcast, we bring you insights from best in the business, top-notch real estate professionals, seasoned agents, and experts in everything from homeowners insurance to mortgages, maintenance, and repairs. Whether you're a first-time homebuyer or a seasoned homeowner, we've got you covered with tips, strategies, and valuable insights to make your journey in Southwest Florida's real estate market a breeze. Get ready to unlock the doors to successful home ownership. This is the 239 Real Estate Roundtable podcast, where we demystify the process, share insider knowledge, and ensure you're well equipped to make informed decisions. Let's dive in.
Hey everybody, welcome to another episode of the 239 Real Estate Roundtable podcast. Our guest today is Brett Swarts. Brett is the founder of Capital Gains Tax Solutions and the host of the Capital Gains Tax Solutions podcast. Brett is a leading expert in Deferred Sales Trusts, or DST for short. Brett helps high net worth individuals defer capital gains taxes on real estate, businesses, and other assets. With years of experience in tax deferral strategies and investment real estate, Brett has been featured on top financial platforms and has educated countless investors, advisors, and business owners on wealth preservation and smart tax planning. Welcome to the show, Brett.
Kevin, grateful to be here. Thanks for having me.
Awesome. Well, why don't we get started? Tell us a little bit about yourself. How does one get into this? It seems very niche, very specific niche in this industry. So who are you? How did you get here? And how does one get into this?
Yeah, it's a good quote. You can start with pain plus reflection equals progress. Ray Dalio said this, and whenever you go through a painful experience, it can unlock opportunity for massive growth and then massive transformation to help others grow before they go through that same experience. And so my big painful moment was my parents got divorced at a young age after building tons of real estate with my parents. We're literally them building it, but me learning about it in the Bay Area of California. I saw massive pain with divorce and as a family and wealth coming between a family. That was the first painful reflection moment where he said, you know what? I want to do this different than my parents did. And I want to do it in a way which, wealth is a blessing and not a weapon. And then the second painful moment came in the 2008 crash. I saw friends, family, and clients lose half or all of their wealth and the market overturning, with a lot of people doing these 1031s prior to that and getting painfully, humbled. Warren Buffett says when the tide goes out, you see who's been skinny dipping. And we're seeing that now. The interest rates, doubling from where they were before, and people getting hurt who overpaid for properties in these 1031s. And so we're seeing it all over again. I saw that in 08. So I learned about our strategy in 09. We reflected on what could we have done better. And really what we couldn't do better is sell high and buy low. That's what our parents taught us to do, Kevin, in real estate. But the problem is, how do you do that when you have to pay massive capital gains tax? And so you're kind of just stuck in between a rock and a hard place, or a 1031 and an overpaid property. And so instead, we learned about a Netflix version of exit planning that we can talk about today that changes people's lives.
Yeah, awesome. Yeah, why don't we dive right in? So, deferred sales trusts sounds very similar to a 1031 exchange, which seems to be the most kind of popular form of this. But what's the difference? How's your strategy different from like a 1031 exchange, and what are the pros and the cons of it?
Yeah, we'll use Blockbuster and Netflix as the analogy. Blockbuster, you have to show up and return the movie in 3 days. You may or may not have it rented out. You have to do the 45, 180, I call it the shotgun wedding approach. Now you're in a single asset type real estate, which is my favorite, by the way. So nothing against real estate, but I like to be in real estate debt these days more than equity, unless we're finding a great value add deal, which we're finding more of those now. But the last couple of years, it's been real estate debt while things were kind of shifting. So, but in a 1031, you can't go into real estate debt. You have to stay in real estate equity for equity. You have to do equal or greater debt, right? So now you're having to stay into debt when you don't want to be in debt. That's another big problem with the 1031. And so this whole swap until you drop, stepped up basis thing can work, but also at the same time, a lot of times clients want what's called truly passive income. They want to get to that fourth quadrant, and they're like made their millions and they're ready to unlock truly passive income, more freedom, more impact for them, for their families. And so it's just an old model. Whereas the Netflix, our strategy, a deferred sales trust, DST, allows you to sell, get out of debt, diversify, go into any asset of any kind, including real estate debt, including ground up real estate development, including business ventures, including, stocks. We had a client did a $17 million exit going into Nvidia stock and it went through the roof. We had a client do a $13 million exit of a real estate business and then went into Bitcoin at 40,000. Now we're over 110,000 a coin. So you can diversify, dollar cost average, no timing restrictions, no like kind replacement requirement. And it's all through an installment sale with a trust. That's the key. It's a seller carryback. We talk about how it works, but ultimately we unlock truly passive income for the purpose-driven entrepreneur or an investor that wants to be able to leverage timing of investments on their own terms, not be, kind of throttled by the 1031 exchange.
Right. Okay. And so it's just there's way more flexibility, it sounds like. And like you mentioned, you're not constrained by these timing aspects of a 1031 is kind of,
Correct.
all that. And also
Correct.
You're not restricted with staying in one asset class, it sounds
Yeah,
like.
you can truly diversify, right? Correct. And have liquidity and be debt free and reset depreciation schedules. I mean, it's like every single part about it is better, except for there are more recurring fees. So that's part of what you pay us the big bucks for. We get a recurring ongoing fee to manage the trust as a trustee. It's not as widely known. People haven't heard of it, so like I've listened to Kevin's show forever and I never heard of this thing, or I thought it was a Delaware statutory trust. They get it confused with that other, I call it the Hollywood Video 1031 exchange package. So it's just really education and getting people understanding what they can and cannot do. You have to give up some control because I'm a trustee. So you have to give up some controls, just like you give up some controls in a 1031 exchange, by the way, for a period of time. So there's some parameters we have to work through. But once you get through the legality, the controls, the fees, and you understand it, that's why also we want to do larger deals, $1 million plus deal exits, right? Then it's like, okay, now we can really see if it's a good fit for you.
Okay. So you're saying this is when you take the fees and stuff like that into account, this really starts kind of paying off when you're looking at some, like you said, higher deals just because of the fee structure. Percentage wise, the fees get lower of the total deal value versus if we do $100,000 10. Okay. Gotcha.
Precisely.
Yep. Okay. Awesome. And have you found, so you said it's not that widely known. Have you found is it like a tough sell? Like, I'm just curious to learn, like when, you pitch this to someone that maybe has considered a 1031 before and, you approach them and say, hey, have you heard of this? Is it usually like a high kind of barrier to overcome, or are people pretty receptive once they actually learn, what it's all about?
I learned from Russell Brunson, when you tell a better story, people can help them overcome false beliefs or limiting beliefs from what they held before. And if someone's open to hear the transformational stories, and of course, the legal track record's perfect, thousands of transactions over close to 30 years, billions and billions of assets, that's all logical stuff. And that makes sense. And we can walk through how it all works. But really, people really want to hear, like, what's the transformation of someone who was in my shoes, who owned a business like me, or Bitcoin or real estate, and has done all of these transactions. We have those amazing clients. They're like family, and they share their story. We do it on our podcast, and sometimes we do it live in person in shoots, and we do it at events. And they go, oh my gosh. Like, so to me, it's more like sharing rather than like, selling somebody something. That's what I would say on this. But yeah, there are absolutely the time constraints. We have to set it up prior to the close of escrow. So really we run out of time sometimes because people aren't doing the planning, or they haven't listened to your podcast and they're not saying, oh, I'm not selling right now, but all of a sudden they get that offer and there are 30 days to sell and now it's out of sight, out of mind, rather than being like, let's dive into the plan. That's why we work on a conditional basis. We literally do all the planning, all the setup of the trust, all of the legal calls, the CPAs, all at no cost on our side. We only get paid at closing. But if you don't take proactive approach to this and you wait to the last minute, and then you're trying to rely on your CPA who's in busy tax season to give it the blessing, and he's never heard of it before, like, you could see why people would be like, well, it's just too much. Well, it's not really too much. You just didn't hear about it either soon enough or plan proactively enough and understand the stories and the sequence of how things work. But by the way, there's still people who haven't heard of a 1031 exchange, Kevin, right?
Right.
It's wild. So like, this is just, get early with us.
Yeah. Okay. Awesome. So you mentioned definitely get in early. There's some lead time, as same with the 1031, but like on a top level, what's kind of like the smartest way to build like a tax efficient exit strategy for entrepreneurs and investors? Like, walk us through the whole process, I guess, and when should someone start and things like that.
It all depends on like, what is your dream? What is your vision for your family mission, vision, values, and for your wealth? So I actually have learned to take a step back, and it's not a fit for everybody. And I really want to, we call it the pressure-free promise. Like, we'll never talk you into anything. We just want to see if it's a good fit for you. And so that starts with asking like you, Kevin, like, what is your family mission, vision, values for your wealth? And how is that particular property or business, real estate, Bitcoin, how is that helping you achieve that family mission, vision, values for your wealth? And has it served its useful, life for the harvesting of it? I'll give you an example. Warren and Catherine, $2.5 million property, Taxifornia. The basis is close to zero. Their NOI is like 120,000. Well, we said, what do you really want? They said, we really want truly passive income. I call that no shoes, no shirt, no problem. You're on Miami Beach or Clearwater Beach with your guitar and your Kenny Chesney with your hat on, and you have a drink in your hand, and you have this passive income just showing up. You're in the fourth quadrant of Robert Kiyosaki, and you're feeling great, right? No time, toilets, trash, termites that you're trading any of that for. And so we sat down and we went through this with them. And I said, what do you really want? They go, well, we really want the two T's, our two twin daughters. We want more time with them. They're 10 years old. They're going to be 18 before we know it. And we want to be able to travel. We want to have some flexibility with our schedule. We don't want Warren driving back and forth between, traffic and all this stuff. And he's like, we're like, okay, well, this is perfect. Let's set up a plan. They can exit the asset. Let's increase your cash on cash to 190, which is what we were able to do. It's like a 60% increase in cash on cash return. But the biggest thing is we radically decrease the time and the energy and the stress that's associated with owning apartment complexes and this particular property, right, for them. So that was the most important thing, right? And so increase cash flow, pay off debt, defer tax, more time with family. That's it. Don't overcomplicate it. So we diversified the wealth. We put it mostly into real estate debt. We bought some deals that are deeply discounted over this last couple of years. And they're like, oh my gosh, this has changed our life. This has transformed our time with our family. So that's in short, what we try to unlock for families.
Yeah, awesome. And do you just generally speaking, I know you're a big believer that you kind of mentioned this transitioning from real estate equity into real estate debt. Obviously, you've mentioned this. One of the big advantages to that is it's truly passive, right? I know you've mentioned the fourth quadrant a couple times. It's truly more passive than being an equity in real estate. Returns are comparable as well or higher, or why do you like it so much?
Yeah.
It's the fact that it's passive.
So 3 years ago, like right before everything we knew everything was high. I mean, I feel like 90% of the real estate market knew it was the peak, and we knew it was a good time to sell. But again, the 100% bonus depreciation and these low interest rates, it was just so alluring to just keep chasing it. But we said, this is not sustainable. And then again, if you only know at 1031, you've got to just keep doubling down otherwise, or not sell or whatever, right? So we said, no, sell, get out of debt, diversify, and let's go into real estate debt. And at the time, it was around like 6%. So it wasn't that attractive, but it wasn't that far off from some of the cash on cash returns, right? And so, but over time, we got to 10%, and now we're up to 16%. But the key is we didn't have to suffer the consequences of staying in debt. We call this having a debt flow mindset. You need to underwrite your debt. And where we took for granted is that these interest rates wouldn't go to where they went. And we took for granted that these teaser rates, would last us long enough. Survive until 25 was the saying, right? Well, this year's the year of the jujitsu tap out. Like, it's over. People are like, I can't survive anymore. The 25 is here, and we thought rates would drop. Nope. And they're tapping out, and they're getting debt arm barred, and their arm's about to break, right? They're getting back to the banks. So we saw that, and we had a solution to get out of it, So that's what we did. And then that doesn't mean we haven't bought equity deals. In fact, we've bought into foreclosures. We bought a deal at $68,000 per unit. It's a 375 unit value add deal, one of the fastest growing states. We think we're going to easily double our money in 3 to 5 years. Like, it's a no brainer. But we dollar cost average went into Bitcoin on some of these at 40,000 a coin, now 110. But mostly it's been 10 to 16% debt. And as interest rates went higher, those opportunities also increased for us on our side. But we could do it in a vehicle, kind of like an IRA, kind of like a 401k, that allows a lot of the efficiency of this is the ability to defer income tax and capital gains tax, income tax for a shorter period of time. But this is what we call a tax flow mindset. So you get debt flow going, you get tax flow, and then your cash flow is there as well. You have all three. We call it looking at this in a 3D quadrant of investing within real estate, not just a 1D or 2D. And lastly, as debt eventually will potentially start going lower, and as we see opportunities, we are buying equity stuff, right? And we just waited 3 years, right, to see the market actually, tap out.
Yeah. Yeah, no, and one thing that you said, or one thing that I think is really appealing to your strategy and your solution that resonated with me is, the timing factor. I actually just went through this myself over the last 2 months, so I'm based in Florida, obviously no secret. Florida is getting hit pretty hard right now with sales prices pulling back, inventory shooting up, all that fun stuff, which was to be expected. Florida always seems to be in a boom cycle. Florida is always right there up top, but then in the bust, Florida is always right there up top or at the bottom as well. So I actually sold one of my properties, and 1031 exchange, I decided against it because it's so weird, the market right now. You don't know where the bottom is. You don't know, are we close to the bottom? Are we just getting started, right? It's kind of weird in Florida right now. So I just decided to eat the capital gains tax because I didn't want to be forced to identify something in 45 days and close. And so I'm going through the pain points that you're mentioning. I went through. So it's something that really resonated with me. So I wish I would have known about this a little bit sooner. So how can someone, speaking about volatility, right? The last 5 years with, COVID and the boom, and now we're pulling back, has been extremely volatile. And, the bond market is making new highs and rates are not kind of seeming to come down anytime soon here. So what is your advice? How can someone future-proof their wealth strategy in an economy like this outside of a deferred sales trust? I mean, I know you mentioned Bitcoins and other assets. So where are you guys at with that?
Yeah, so diluted focus gets diluted results. So the number one mistake we see people making is they get this idea of like, I need to get 7 different income streams, right? These 7 different passive income streams or active income streams and all these different things. And they dilute their focus and they get diluted results. They also are not focused on what's called the truly passive, we call it the TPI number. What is your truly passive income number? Is it 10,000 a month, 20, 30, 40,000, 50,000? I know ours for my family is 30,000 per month, where it's truly passive, no shoes, no shirt, no problem. We believe that truly passive income is to your freedom and impact, is compounding interest is to your money. And when you grasp that and you focus like a laser on getting to that number, and we call it the big domino effect, if you can get to that number and you can achieve that, the big domino falls over and a lot of the other financial things go away, okay? Or they become irrelevant or just less important. And then of course you can work on 7 different income streams from there, right? When you've achieved that truly passive income number. So I've had to learn this the hard way. I mean, growing up, it was like, okay, we're going to sell real estate as a broker. We're going to get on the other side of the phone. We're going to own real estate. We're going to syndicate. We're going to raise capital. We're going to do this, we're going to buy Bitcoin. We're going to, all these different, we're going to fix and flip, maybe Airbnb. And then we're going to do the real estate professional status. And then, you just keep going. And you can do 100 different, real estate strategies to make all the millions of dollars. And it's like, man, like, why don't I just focus like a laser and getting $30,000 a month that's passive? And then sure, I can dabble on that other stuff. So our main engine is like all in on capital gains tax deferral solution. We're going to be the best in the world at what we do. And that's going to be how, billionaires make their money like on like PayPal, for Tesla, right? For Elon. And then you have all of the other major ones. They're going to make it in one area. Then they're going to diversify, right? Versus the opposite. So that's what I would say. Like if you want to future-proof, becoming the best in the world at what you do, your superpower, make massive money there, get it into something that's truly, investments into something that's now truly passive that can unlock that amount per month. Then do the rest, right? But don't pass go, don't collect $200 until you've gotten that achieved.
Yeah, very cool. I always say, don't chase too many rabbits, right? The fox that chases 5 rabbits, they're not going to get one, but if fox in an open field chooses 1 rabbit, his odds just increased of getting that 1 rabbit. So, tons of different analogies, but yeah, it's a good analogy. And then I'm going to throw you a little bit of a curveball here. I know you've mentioned some books and some quotes. Listeners, if you were to give them one book in kind of that matches what we just spoke about, what book would you recommend?
The Bible.
The Bible. Okay.
Yeah. You had to start with your faith, right? So you had the major areas of your life, your faith, your family, your fitness, personal development, leadership. But you've got to be focusing on the things that are helping you grow eternally, right? Not temporary. I think we too often get distracted with the temporary, and we wonder why are we not fully living to the possibilities of what the Lord's given us, right? So that's the Bible, right? And if you want to say, well, I'm not a believer, well, you're a believer in something, right? And so I would say pick up the Bible still and read it and see if you can't learn some wisdom from the book, from the great book. And as far as like, some business and negotiation, the art of negotiation, Chris Voss, never split the difference, but there's an actual masterclass that I recommend everyone, regardless if it's, it's human relations, it's communication, but the art of negotiation and learning mirroring and labeling and ways to connect on a deep level with listening, that has helped me tremendously. I've probably watched it 50 to 60 times. Over and over and over again. It's that rich and that deep. He was a FBI negotiator, a hostage negotiator around the world, one of the best ever to do it. And he has tremendous knowledge and wisdom on how to communicate in an effective way. That would be a couple of recommendations for you.
Awesome, man. Yeah. And I like the last part that you said with, focus on listening. I'm reading 7 Habits of Highly Effective People by Stephen R. Covey right now, and habit number 5, listen to understand, not just to listen, essentially. I know I botched that a little bit, but that's kind of the gist of that habit. And we always used to say, God gave us 2 ears and 1 mouth for a reason, right? Listen your way into the sale. So I like it. We're on the same page there. All right, Brett. Well, I want to thank you from the bottom of my heart for your time. We are going to link all of your contact information and your socials and everything down below. But if someone wants to learn more about the services that you offer and a DST, where would be a good place to start?
Yeah, you get the book, Building a Capital Gains Tax Exit Plan. We have Kevin Harrington from Shark Tank in the book. We had #1 bestseller on Amazon. We've got Tony Robbins, one of his CPAs in the group too, in the book. And then you can go to capitalgainstaxsolutions.com to get started and find the book. You go to brettswarts.com too if you want to follow me on social media. All of my adventures with my family, my wife and I, 5 kids. I do jujitsu. I played basketball in college, a little bit of background, a little personal stuff. I have 4 daughters and a baby boy. And we actually live in Florida too, but we have, team members in Texas, team members in California. But yeah, capitalgainstaxsolutions.com or brettswarts.com.
Awesome, Brett. Thanks for your time, and we hope you have a great rest of your day.
Thanks, Kevin.
And that wraps up another insightful episode of the 239 Real Estate Roundtable podcast. I hope you enjoyed our discussions and gained valuable knowledge to enhance your home ownership journey here in Southwest Florida. A big thank you to our incredible guests and of course to you, our listeners, for joining us. If you have any questions or topics you'd like us to cover, or if you'd like to connect, feel free to reach out. You can find us on Instagram at @KevinTremmel_real estate, on Facebook at Kevin Tremmel Real Estate, or visit our website, kevintremmel.com. Don't forget to subscribe so you never miss an episode. Your feedback is crucial and we're always eager to hear from you. Until next time, this is Kevin Tremmel, your host, signing off. See you on the next episode.